give us an idea of these concerns and how they're affecting your anticipation, your search for yield and indeed returns.
Well, I think clearly at this time, especially towards the year end, all these geopolitical concerns, some of them start off like local bushfires, and they can envelope and they can develop into something very big. So we're very vigilant of this on these concerns. But at the same time, we also look. I was here just 2 months ago, and I talked about the massive amount of liquidity that the central banks have pumped into the market, 12 trillion of liquidity, of which the U.S. is trying to do kind of a normalization process. But certainly in Europe and in Japan, the liquidity continues to be pumped into the system unabated. So you have a situation whereby what we coin as the uncertainty is high, but the volatility and the financial market risk is actually low because of all the liquidity that's pumping by the central bank. So we're vigilant, but I think the reach for yield, you look at graying populations in much of the developed world, you look at the current account surplus that's been generated in the Eurozone, the amount of savings that's looking for a home, I think the search for yield continues, even though you have all these uncertainties that are, as usual, in the background.
Against the backdrop of monetary normalization in the US, possibly in the medium term, that's affected the yield curve and flattened it, ironically, in the US in a funny sort of way. But that also plays out in this part of the world. How are you seeing that?
Well, Rich, you're indeed right. If you look at the yield curve in the U.S., take, for example, the 5 and 10s, we have flattened from 55 basis points at the beginning of the year to 34 basis points. And if you look at the 10 and 30s, we have come in from about 70 basis points to currently 47 basis points, just under 50 basis points. I look at the situation right now of what we call the bear flattening of the yield curve to be pretty similar to the episode in 2004 and to 2006, whereby U.S. Fed under Chairman Greenspan actually raised interest rates by 16 times on 25 basis notches. And yet, if you look at the behavior of the long end of the curve, you look at what happened to the 30-year bonds, it actually remained, the yield curve remained as flat as a pancake. The 30 years did not move. And at that time, I think it was the Greenspan coined a term, the conundrum of savings, the glut of savings from the emerging market, particularly from Chinese official reserves. I think this time, even though Chinese reserves have come down by to about 3 trillion, the amount of private Chinese money that is parked overseas offshore continues to be very, very large. By some indication, there's like 700 billion of Chinese yuan, of FX deposits in China onshore, and there's more than 500 billion offshore in dollars. I think that the real number is a lot larger than that. So we have this time more private savings. And I mentioned earlier, the Eurozone today has a 7% current account surplus. Again, graying population, savings that continue to anchor the long end of the curve. The Fed is not really normalizing. I guess it's moving from
so Desmond, let me jump in and just clarify. You don't think that the flatness in the flatness in the curve portends anything in terms of doom and gloom? It's purely a demand side phenomenon on the long end.
Yes, very much so. So I think there's a lot of demand for long-term assets, a lot of demand for fixed income, given the graying population. So it is not a recessionary indicator as far as I'm concerned.
Well, in the grand scheme of things, then what does really at the moment, perhaps not now, but in your view, in about 6 months' time, represent value and return?
Well, I guess there's no mystery that everything is pretty richly valued. Everything is finely valued, whether you look at stock PEs, you look at bonds, especially where in my universe, things are very rich. But I think when you look at a strategy in terms of the fixed income market, I think I described earlier that the demand for fixed income remains strong, remains unabated, and B, really the government bond use, which you look at it as a sort of a nuclear kind of fission diagram. At the center, treasuries, Fed funds, and as these sovereign bonds yields are very low, we have to move out to the risk spectrum. We move out to the yield spectrum, go and buy corporate bonds, buy emerging market, and then it will continue to extend that out. So that, I think this strategy is still good for next year, that the market continues to want to increase the yield of their portfolio, and we just have to move a bit further out in terms of the credit and in terms of the risk spectrum.